In the world of tech, a unicorn is a legendary creature. A private company valued at over $1 billion. They are seen as symbols of innovation, disruption, and infinite potential. But what happens when the legend dissolves? When the billion-dollar valuation is revealed to be a mirage? This is the untold story of the spectacular collapse of Silicon Valley's paper giants. We are dissecting the core reasons why these heavily funded unicorns suddenly fail. And most importantly, we are giving you the financial blueprint to spot the cracks before they collapse. The failure of a unicorn is almost never a surprise to those inside the financial loop. The process is slow, driven by 4 fundamental flaws in the modern startup ecosystem. Flaw 1. The relentless pressure to prioritize growth at all costs. Valuations are built on future market size, not present-day revenue or profit. This forces companies to spend recklessly on marketing, acquisitions, and expansion. Flaw 2. The founder's delusion, where narrative replaces reality. Founders become obsessed with their valuation number, treating it as revenue itself. They refuse to pivot or make necessary cuts because it contradicts the billion-dollar story they sold. Flaw 3. The unicorn trap, a mechanism baked into venture capital funding. Late-stage investors often receive preferred stock that guarantees them their money back first. This artificially inflates the reported valuation, but hides the risk to common shareholders. Flaw 4. The revenue mirage, where gross revenue is mistaken for healthy margins. Many unicorns sell products below cost just to claim high-speed customer acquisition. The entire business model is reliant on an endless supply of cheap, optimistic venture capital. If you are interested in the hidden dangers of modern finance, like this video and subscribe. Your support helps us peel back the layers of Silicon Valley mythology. Let's examine the balance sheet warning signs you need to look for. The first crack is the burn rate. How quickly the company is spending its cash reserve. A healthy company should see its burn rate decrease as revenue scales. Unicorns often see it accelerate. A high burn rate is the financial engine running out of gas. The second crack is negative gross margin. The most obvious sign of a broken model. The cost to produce the good or service is greater than the revenue it generates. This means the company is losing money on every single sale, guaranteeing a collapse. The third crack is a continuous, desperate need for new funding rounds. When a unicorn is constantly raising money just to cover payroll, it's not growing, it's surviving. Each new round typically comes with crippling terms, further eroding the original investor's stake. The psychology of the collapse is a critical factor often overlooked. Once the founder's story begins to unravel, the company loses its most valuable asset, faith. Employees start quitting, suppliers stop offering credit, and customers grow nervous. The media narrative quickly shifts from disruptor to doomed, creating a spiral. The collapse of a major unicorn sends a shockwave throughout the entire startup ecosystem. Investors become conservative, cutting off oxygen to other similar companies. This market correction is painful, but it is necessary to clear out unsustainable growth. The final collapse is often triggered by one simple, unavoidable event: an IPO failure. When a company tries to go public, the scrutiny of Wall Street forces transparency. The public market demands profit, not just potential, immediately exposing the revenue mirage. The failure to meet the IPO valuation often leads to layoffs and a rapid devaluation. The biggest names that have survived avoided this trap by pivoting early and ruthlessly. They replaced the culture of recklessness with a focused, disciplined path to profitability. The founders who succeed learn to love generating cash more than generating headlines. The Silicon Mirage reminds us that a billion-dollar valuation is simply a negotiated price. It is not a guarantee of viability, longevity, or real-world success. The entire ecosystem, VCS founders, and media are complicit in creating this mirage. We are collectively addicted to the excitement of the next big thing, ignoring the financial fundamentals. The lesson for every investor and entrepreneur is simple. Asterisk, asterisk, cash is reality. Valuation is narrative. Asterisk, asterisk, to spot the cracks, you must stop listening to the story and start reading the balance sheet. Look for the companies that are boringly profitable, not explosively viral. The true winners are built on sustainable margins and a relentless focus on the customer. The Silicon Mirage will continue to claim victims until the culture of growth at all costs is broken. We must demand accountability and transparency from the private market giants. Share this video to empower others with the knowledge to navigate the treacherous startup landscape. Help us shine a light on the financial fundamentals that truly matter. We will continue to track the signals and analyze the implosions that shape our economy. Thank you for watching this essential guide to spotting the cracks in the unicorn wall.